Hi there, this is Ten. Today we'll be talking about the recent market call in Wall Street. A huge hedge fund had to incur massive loss when it received numerous margin calls. Even though there should be a risk manager in a hedge fund, there is too much leverage in a company. So in this video, we'll be talking about whether the recent margin call will tell us anything on the underlying stock market. Before we continue, please smash like button, and if you'd like to see more such videos, please subscribe to this channel. Firstly, we will be talking about what is a margin call. A margin call occurs when the value of an investor's margin account falls below the broker's required amount. An investor's margin account contains securities bought with borrowed money, typically a combination of the investor's own money and money brought from the investor's broker. A margin call refers specifically to a broker's demand that an investor deposit additional money or security in the account so that it is brought up to the minimum value, known as the maintenance margin. A margin call is usually an indicator that one or more of securities held in a margin account have decreased in value. When a margin call occurs, the investors must choose to either deposit more money in the account or sell some of the assets held in the account. Given that the stock market is extremely volatile recently, there is always a chance that any stock could drop huge in the short term. Normally, we will take the drop lightly and hope that the stock price will increase eventually. However, given that the hedge fund is using other people's money, these people would not like to lose any money. Hence, this hedge fund have to force itself to sell the position by the banks. Secondly, we will be talking about the hedge fund that caused the margin call. Oculus Capital Management is a family office run by Bill Huang. Oculus holdings were primarily in the form of total return swaps, a financial instrument where the underlying securities are held by bankers. This means that the fund did not need to disclose its large holdings, while if it has transacted in regular stocks, it would have had to. The fund was also heavily leveraged and did business with multiple banks, which were likely unaware of Oculus' large position held by other banks. Next, we will be talking about who is behind this margin call. A massive margin call affecting a little-known family office, incurring billions of dollars in loss for certain banks involved and jolted the overall volatility of the broader market. Oculus Capital Management leveraged bets in Viacom CBS, blew up and enacted a whopping $20 billion wave of forced liquidation at a slew of Wall Street banks, some of which faced losses that could be, quote, highly significant. Oculus Capital Management is a family investment vehicle founded by former Tiger management analyst Bill Huang in 2013. He was a protege and one of the so-called Tiger Cubs of legendary hedge fund manager Julian Robinson, who mentioned and supported some of the best performing investors including Stephen Media, Lee Ansell, and Chase Lemon. Before Oculus, Huang built the New York-based hedge fund Tiger Asia Management, which focused on Asian investment. In 2012, Huang pleaded guilty to insider trading of Chinese bank stocks and agreed to pay $44 million to settle charges with the SEC. The agency alleged that he used confidential information received in private placement offering to short sell 3 Chinese bank stocks. After the settlement, Huang closed Tiger Asia Management and Oculus was born. Oculus held large and leveraged bets in US mini stocks, Viacom, CBS, and Discovery, as well as a few Chinese internet giants including Baidu, Tencent, and Vipshop. Some of the positions were held via total return swaps, a type of derivative that allows investors to take big leverage stakes without disclosing their position publicly. Given that the man that runs this fund was once charged by the SEC for fraud, I do not know why the banks would borrow a massive amount of money to this fund. Finally, we'll be talking about whether there are regulations to control the amount of leverage this hedge fund should have. The divergence fortunes of major banks in the fallout from the Archegos capital management meltdown raised serious questions for global regulators, experts said. Archegos' forced liquidation of several of its positions triggered a fire sale of several US middle stocks. Nomura and Credit Suisse announced that they expected to suffer significant losses after the $1 million family office defaulted on margin calls. Both banks have served as prime brokers to the beloved hedge fund. However, fellow brokers Goldman Sachs, Deutsche Bank, and Morgan Stanley escaped relatively scot-free, having already unloaded positions relating to their Archegos margin calls. The margin call defaulters are estimated to have cost the bank around $6 billion in total. Reports suggest that several of the banks have communicated with one another on the Archegos squeeze. Some proceeded to unload their position in the nick of time, while others were left holding the bag. Former SEC lawyer Mark Beeman said regulators will be looking not just at how Wall Street prime brokers allow Archegos to build such heavily leveraged positions, but also the bank's collective approach to credit negotiation and risk management. Next, we will be talking about how a US politician feel about the margins call of Archegos. Senate Elizabeth Warren aimed at Archegos capital management and a lightly regulated hedge fund industry after the stock trade sent the market into a frenzy. Quote, Archegos meltdown had all the makings of a dangerous situation, largely unregulated hedge funds, opaque derivative trading in private dark pools, high leverage, and a trader who winged out of the SEC enforcement, Warren told CNBC in a statement. Warren, who is a member of the powerful Senate Banking and Finance Committee, is one of the first lawyers to respond to what turned out to be disastrous trade by Archegos, a family-owned founded by former Tiger Management analyst Bill Huang. Goldman managed to sell most of the stocks related to its Archegos margin calls. Helping the firm avoid any loss. In this episode, according to one of its people, Morgan Stanley sold $15 billion in shares over a few days, avoiding significant loss, CNBC Leslie Pickers reported. Next, we'll be talking about how Archegos for exposed risk from less regulated family office. Family office have grown in the US, but the segment remains lightly regulated, and that could be a problem for the financial industry. Warned a former counsel at the SEC. The risk posed by a large family office came under the spotlight after the multi-billion dollars Archegos Capital Management was forced to unwind more than $20 billion in trade. Goldman, now a part at law firm Dowsey and Whitney LLP, pointed out that Archegos has built massive positions in the markets with borrowed money and used instruments that were also, quote, not heavily regulated. Given that during the 2008 financial crisis, most banks started to experiment with different plans that could allow these banks to benefit from the market, This caused them to be extremely greedy in the market, which led to the crash. Currently, this fund is trying to create a new product that is only not regulated by the regulators, but they also have no clue on what they create. Hence, the recent crash of the fund is great for the market, as the problem has surfaced up before much damage to the stock market. In conclusion, the recent margin call is a great wake-up call for the stock market, given how regulators have time to investigate before more of such products flow into the stock market. The regulators could try to prevent the fallout of this margin call. However, if the regulators fail to rectify this issue, I fear that we might be experiencing another stock market crash of the same magnitude as the 2008 financial crisis. Even though this time, no retail investors are caught by this shock, I fear the next will be extremely devastating. With that, thank you and have a nice day. Goodbye.